Hello, everybody, and welcome. We're now at the final approach of new adjusting journal entry questions. We're going to go through part two of this comprehensive problem. So just really quickly, this is by myself, accounting professor, not the accounting professor, just accounting professor, Professor Tchaikovsky. This is copyright 2008 to 2024. All rights are reserved. Any redistribution is strictly prohibited without the prior written consent of myself. Opinions expressed herein are those of the authors only and do not represent those of Irvine Valley College or the South Orange County Community College District. So let's go ahead and take a look. So we've done the trial balance, we've gone through and we've done the adjusting journal entries. So now what we're going to go through and do is we're being asked to prepare an income statement. So, and for the year ended. So the first thing I need to do when I do an income statement, name of the company, income statement, for the year ended 12/31/24, revenues. So here, because I've set this up correctly or the best I can, consulting services revenue and interest revenue. My consulting services revenue was 197. My interest revenue was 4,500. So my total revenues are going to be 201.5. When you see me indent, don't have to do that on a financial statement. Only reason why I'm going through and doing it is so that you know that I'm adding up numbers. My expenses over here, I've got consulting services expense, utilities expense, depreciation, and interest expense. So when I add these up, so my total expenses are going to be 56 plus 28 plus 16 plus 5,400 or 105.4. So my net income is going to be 96.1. Sounds like a radio station. Now, one of the things that you may notice is that if we were to go through and look at another company's financial statements, and we're just beginning to learn financial statements. So I really want you to kind of just be not freaking out. We're just learning things. What we're doing is something called a single step income statement. We're basically saying our revenues minus our expenses is going to give us our net income. Now, when it comes to interest expense and interest revenue, technically, these should be classified as an other income or expense. However, for all intents and purposes, right, I'm more concerned with you knowing revenues minus expenses equals net income. So for this exam, right, I'm absolutely fine with you showing it this way. There you go. Okay. Next thing I need to do, DDI, statement of retained earnings. For the year ended 12/31/24. How did I know to write that? Well, right over here says prepare a statement of retained earnings for the year ended 12/31/24. What exactly is our statement of retained earnings? Well, it's the amount of the net income that we are keeping as a corporation and not distributing to our shareholders. We always start with our beginning retained earnings, as this was the first year of operations. This is going to be 0. We're adding our net income. Do you have to put a plus there? No. Basically, I do it so you know to add it. Less our dividends. Our dividends over here, we're at 27. So our ending retained earnings is going to be my beginning plus my net income minus my dividends is equal to 69.1. Okay. So the next thing I have to go through and do is I have to close out all of the temporary accounts to retained earnings. What does that mean? Well, it means that all of these accounts, these are temporary accounts, meaning that they showed me what I earned or what I used during a period of time. So I need to close all of these out to retained earnings using T accounts. So let's go ahead and do it. So we're going to make a big account here for retained earnings. And my beginning balance and retained earnings is part of owner's equity. It represents the net income that we are keeping, that we've earned, that we're not distributing. So over here, I'm going to list out every revenue and expense account that is showing up on my trial balance or on the income statement. So over here, we have consulting services revenue had a balance of 197. Just pulling that from the trial balance. Over here, we had interest revenue of 4.5. Got to do this for every single one of the revenue and expense accounts. Over here, so I come over here, I've got consulting services expense had a debit balance of 56. Over here, I've got utilities expense had a balance of 28. Depreciation expense had a balance of 16. Interest expense had a balance of 5.4. Now, the one I left out was dividends. My dividends had a debit balance of 27. So again, if I look here at the trial balance, the revenue accounts have credits. Everything else has a debit balance. So now what do I need to go through and do? Well, I need to go here and I basically need to make all of these temporary accounts go to zero, right? That's my goal here. So just give me 2 seconds to make this a nice, colorful journey. So, okay. To make consulting services revenue go to zero, I need to debit consulting services revenue for 197. For every debit, I need a credit. So I'm going to credit retained earnings. Interest revenue. To make this go to zero, I need to debit the account for 4.5. I do the opposite to retain earnings or 4.5. Consulting services expense, utilities expense. To make all of these accounts go to zero, I need to credit these accounts. When I credit these accounts, they all go to zero. But for every credit, I need a debit. So what I'm going to go ahead and do is I'm going to debit retain earnings for the consulting services expense, the utilities expense, the depreciation expense, the interest expense, and lastly for dividends. Very important when I go through to basically make sure that my work is good. My total debits were 132.4. Total credits were 201.5. I subtract the smaller from the larger balance and leave the remainder on the larger side, which is in this case a 201.5. My ending balance here in retained earnings is 69.1, which is the amount that is right over here, or 69.1 that is in my statement of retained earnings. Now that this is done, I am ready to go through and prepare a post-closing trial balance. What we just did is by closing out all of the temporary accounts to retain earnings, revenues, expenses, dividends, close them out to retain earnings. Now what we need to go through and do is to now basically make our post-closing. When we do the post-closing, and this is all should be very familiar to you from the very last exam, nothing on the trial balance is changing on the adjusted side, except for we now have a new balance for retained earnings. Dividends went to zero. The revenue accounts went to zero. All of these expense accounts went to zero. So now I've got total debits of 641.5, total credits of 641.5. So now that I've done this part here, what I'm going to go through and do now is I am going to go through, give myself a little bit more room, and I'm now going to prepare the balance sheet. When I prepare a balance sheet, this is going to be a little bit different. I have to prepare a classified balance sheet. This is very important. A classified balance sheet, and we're going to go ahead and look over here at Apple. When I prepare a classified balance sheet, what I'm doing is for the assets and liabilities, I am separating them between current, meaning those I'm going to use or receive within a year or basically use within the year, and non-current. Liabilities, current versus non-current, right? So when I come over here to our question, I'm preparing a classified balance sheet. So over here, we've got DDI, balance sheet, as of 12/31/24. I start with my assets, but instead of listing out everything, I need to separate them. Current assets. Okay, what are going to be my current assets? Cash is going to be a current asset. Accounts receivable is also going to be a current asset. What about the loan receivable? Remember, when we're going through and deciding whether or not something is going to be current or non-current, we're at 12/31/24. In order for something to be considered to be a current asset or a liability that we have to settle, it has to come out within the next year. When I look at the loan receivable, right, this is going to be received by us on 9/30/27, which is not until in the future. So that is going to be a non-current asset. So my only two current assets are cash and AR. Equipment by default is non-current because it's giving us multiple periods of use. So my total current assets are going to be 317. My non-current assets is I'm going to have a loan receivable, interest receivable. My loan receivable is 180. My interest receivable is 4.5. Now, when it comes to equipment, I'm very, very particular about certain things if you're taking my class. The way you have to show this on the balance sheet is kind of similar to what we kind of went through and looked at earlier when we were doing with property, plant, and equipment. I want to see PP&E. Less accumulated depreciation is going to give you property, plant, and equipment net. So we're going to have equipment. My equipment balance is 140. Less accumulated depreciation. So this is going to be minus 16 is going to give us equipment net of the accumulated depreciation of 124. So when you show this on the balance sheet, you have to make sure you're showing me this. It's non-current. So my total non-current assets are going to be the loan receivable, the interest receivable, and then the equipment net. My total assets will therefore be my current assets plus my non-current assets, or 625.5. Is that right? I have no idea. Let's keep going. So my non-current, my liabilities. I have current liabilities. Current liabilities. By definition, accounts payable is going to be current. So my accounts payable at 90 will be a current liability. What about unearned revenue? Well, when we look at unearned revenue in the last video, we kind of said that, well, I have 10 months remaining. So that's going to be a current liability because we're going to be satisfying that unearned revenue in the next year or the next 10 months. Now, what about the loan payable? Well, in order for a loan payable to be classified as a current liability, it has to be repaid by 12/31/25. But this is not going to be paid until 3/31/30. Therefore, the loan payable will be non-current. So my total current liabilities are going to be 270. My non-current liabilities will be the loan payable, the interest payable. My loan payable was 120. My interest payable was 5.4. My total non-current liabilities are going to be 125.4, meaning that my total liabilities are going to be 270 plus 125.4 or 395.4. Now, when we're doing a classified balance sheet, we're only concerned with the assets and liabilities. The owner's equity really doesn't change, or stockholders' equity. So for my owner's equity, I'm just going to have two accounts for right now, common stock and then retained earnings. My common stock was at 161. My retained earnings were at 69,100. So my total owner's equity is going to be 230.1. Now, am I done yet? Well, the problem is I haven't shown that my total assets are equal to my liabilities plus my owner's equity. So I'm now going to say total liabilities and owner's equity. This is going to be 625.5, which equals my total assets. So obviously, if you're taking my class, this is going to be when you look at a 175-point exam, this problem is probably going to be close to about 110 or 120 points of the test. And I can tell you from having taught this class for whatever the last number of years are, this is by far one of the most challenging exams. I, you know, but it's by far the most important for undergraduate financial accounting, because when you take intermediate accounting, the first thing I do, I give my students an exam like this and kind of say, well, do you know how to go through and, do you know how to go through and record transactions? Do you know how to prepare financial statements? And all I can tell you is that the more you practice, the better off you're going to be in the future. And in any event, thank you so much for joining me on this video series. This is going to be the last one for adjusting entries. I look forward to seeing you on future videos. Have a great rest of your day.